So what do we do now? We could buy the dip, but then the question is, what dip? Obviously, software is down big. S&P 500 and Dow having their best day since May of last year. Dow over 50,000, S&P 500 almost back at records. What do you do?
Yeah, Jared, I think we did miss that opportunity to buy the dip. Clearly that mentality here is alive and well. And one of the more healthy things about this market, as you all just pointed out, is the breadth that's emerging. We're, looking at sector participation that's increasing. We've been advocating for areas like industrials, which are sort of our favorite cyclical part of the market. Those stocks doing well, financials seeing outsized earnings results for the fourth quarter. So we like the breadth that's pervading markets here. Certainly tech here taking a little bit of breather. I would say that's not totally surprising, given that the valuations were pretty egregious in this space. So I think just sort of a healthy breather here for the technology space, but from some nice participation across other areas of the market.
Yes, I know you've been hot on the industrials, and they've been doing very well this year. Caterpillar hitting a record high today, I believe. And even the Dow Industrials and both the Dow Industrials and Dow Transportation indexes have both been hitting record highs. So there's your Dow theory. But what do you do with tech? Is it time to step in? Do you buy some of these software names? Have we seen the capitulation, or you just say, all right, I'm going to hold off and wait a little bit?
Yeah, look, I mean, these are the best companies in the world right now. A lot of these businesses are so solid. They have great balance sheets. They have great return on equity, really high quality, great, earnings growth prospects. The challenge is that portfolios have gotten so much out of the technology space. It's been an asset allocator's dream return driver. And you have this environment now where consumer net worth right now is $173 trillion. And for the first time since the late 1990s, consumers own more stocks than they do real estate. So you've seen this massive appreciation, primarily driven by AI and tech, that's contributed to this overconcentration in stocks and in tech primarily. So we still like it. Tech, is still attractive to us, but we really want to think about rounding that out, which is why we're using the mantra quality at a reasonable price, or quality value right now in portfolios. And again, that's a function of that sort of broadening out that we're seeing. We like mid-cap stocks here as a diversifier from that tech space. When you go down in market cap into mid-caps, you're still getting high quality. You're getting a very different sector composition. You are going to get more of those industrial stocks. You might get some more financials, regional banks right now benefiting from M&A activity. So it's kind of like that go-to outfit in your closet. I don't know if you have one of those.
I'm wearing
it.
You kidding
That's
me?
technology stocks to us. And we don't want to necessarily get rid of that go-to outfit, but we want to sort of think about rounding the closet out.
All right,
now.
Let's talk about the economic data that's coming in. We're looking ahead to the big monthly jobs report next week, along with inflation, CPI. This week was not the greatest on the labor front, and I know you're writing that the run it hot story by the Fed, that is run the economy hot, cut rates, whatever, might be a mirage. So talk to us about that.
Yeah, there's this idea that the economy is really heating up here, and we don't see it as being that hot. In fact, some elements are pretty cool right now. Yes, there was a beat in the ISM data, both on the manufacturing and the services side. But if you look at the labor market, it was not great this week. You saw the biggest number of layoff announcements from Challenger in the month of January ever. We've seen job openings slow to the lowest level since 2017. So we are seeing pressure. Of course, we had those 3 negative jobs reports. There is some noise around that given the government shutdown and federal employees. We're going to get another labor report next week, which we'll be watching closely. The breadth hasn't been there as far as the job gains. They've all been driven from healthcare. And then we're also watching some disinflation coming from the housing market. Truflation right now has inflation below 1%. So all of this, what it means for portfolios is we actually think that rates are not sniffing this out. We think bond yields can come down and investors can benefit from the income that's available in high quality bonds today.
Let's stick with bonds here, because I was watching the price action this week, and when stocks were nosediving, a couple times this week, but also especially yesterday, we did see this flight into quality. That is, we saw bond yields ticking down as bond prices were going up. That means investors were going to that. And that was a departure from what we saw in April of last year when it was sell America, including the bonds and the dollar. It was nice to see that, but talk to us. So you like treasuries as opposed to corporate, or just kind of explain your reasoning there?
Yeah, that was really nice, wasn't it? Like everything we ever learned in the textbooks, like actually worked, which was nice. Same thing with the dollar. So we really like high quality bonds in general. It's investment grade corporate bonds, or about as much risk as we want to take here. We like the elevated income that's available in high yield bonds, but we just don't see the fundamentals being attractive with credit spreads as tight as they are today. So it's mortgage backed securities, it's treasuries, it's investment grade corporate bonds, it's municipal bonds. Basically anything boring is what we like right now because the yields are elevated. The 10-year treasury yield is still above 4%, which we think is pretty unusual in an environment where there is moderating inflation, where there is a weaker labor market. The bond market just hasn't sniffed that out right now. Bonds are kind of dazed and confused. They don't know where to look. They're thinking about what's going on with Japanese bond yields. They're thinking about the implications of a Kevin Warsh as a Fed chair. So there really has not been a focus on the macro picture. We think once bonds sort of come out of the fog of confusion, they're going to refocus on what matters, which is inflation and growth moderating. That brings bond yields down. It allows the Fed to cut, and it benefits you as a fixed income investor.
In your notes regarding bonds, you say it's complicated. I like that. Let's stick with boring. Last question here. We saw in January some of the more boring sectors, the defensive sectors like staples, healthcare, utilities, even real estate, kind of come alive. And you could throw energy in there too. What do you think about that? Is there a more defensive posture in the market right now? Is that saying anything concerning?
Yeah, we've been overweight utilities, and of course, that's also a play on AI and all the build out around data centers and the demand there. Another area that we've been emphasizing is infrastructure stocks. This is the stuff that people need versus the stuff that they want. We think that we've had an incredible run for risk assets here, 3 back-to-back double-digit returns for riskier parts of the market, for the market broadly speaking. So thinking about something more defensive here, whether that's those traditional dividend paying sectors, although the dividend yield in the S&P 500 is at a record low at 1.1%. So you want to be thoughtful there, but leaning into those more defensive areas, utilities and infrastructure among our favorites.
Emily, lots of great insights there. Thank you so much for joining us.
Thank you.